All right, again, we lost steam in the second quarter. What brought about that slowdown?
Yeah, I think at the top half of the segment, you did have Secretary Balisacan talking about how inflation was the likely culprit. 70% of this economy is household consumption, and when you have inflation accelerating at this pace, I think for the quarter it was at 5.4%. Definitely taking some wind out of the sails of consumption. The main, I guess, contributor to the slowdown was basic food, and with inflation above target and now at 6.4%, we can only expect this to pull back further.
Given that, is the worst over here for inflation, or is the road just about to get more bumpy? How do you think inflation will play out for the rest of the year?
Yeah, well, we think that inflation is just starting to heat up. We had, I guess, discussed previously that the first half of the year we saw inflation pick up largely due to first round effects. This is because oil is more expensive. Imported items are more expensive. Now we're starting to see in the second half of this year, the second round effects really kick in. This is when the wage hikes begin to take effect. This is when the transport fare adjustments begin to take effect. And this is when all the firms that have largely kept prices unchanged. This is when they finally decide it's time to tack on more on sticker price, because it doesn't look like inflation is going to be slowing down in the near term. We have inflation peaking in October at 6.8%.
6.8% by October, but do you also see emerging demand side pressure here?
Oh, definitely. A lot of this is demand side pressure. I mean, even if our growth slowed to 7.4%, it's still nothing to sneeze at. Higher wages are just going to push inflation higher. And, despite the slowdown, it's still quite a robust and healthy, good-looking number.
Okay, given all those things to be considered, should we be bracing for more pain ahead in the second half? How does this all play in for full-year growth targets?
Yeah, unfortunately, we're running smack into the triple threat that we discussed previously. The three-headed monster of higher inflation, rising interest rates, and the relatively high debt-to-GDP ratio. These are the three sort of direct counterbalances to the major sectors of the economy. Add to that the trade numbers that came out yesterday sort of portend or point to another significant drag on the economy. One other thing I wanted to point out that the growth numbers showed yesterday is that the net exports continue to be a substantial drag on the economy, largely because our import numbers are surging at the time that our export numbers are just managing to eke out modest gains.
Okay, let's touch on more on those trade data later. But for now, again, you have the government targeting 6.5 to 7.5%. How likely is that to happen, and what would it take to reach the ceiling of the target band?
Yeah, well, I think that for one thing that we have to come to terms that we might have to accept the lower end of the official government targets, something closer to 6.5%. But with the way that inflation is really kicking higher and with interest rates just about to rise, BSP rather aggressive in its rate hike cycle. This is definitely going to stunt some of that nascent capital formation that we just saw picking up. That's 6.5%. We have it at 6.3, 6.2% now. One way that we can get this number up is if inflation definitely falls down, decelerates rather quickly. This will be a good boost to consumption. But from where we sit right now, it's going to be a tall order.
Now, how will all this factor in the BSP's next policy meeting? Should the BSP still be as hawkish and raise rates by 50 basis points as they have signaled earlier? And do you see them maintaining that stance for the rest of the year?
Yeah, I think BSP has to maintain its hawkish sort of rhetoric, carry out that 50 basis point in August just to stay ahead of the curve. They did the emergency rate hike. Largely unexpected, mainly because they'd fallen so far behind the curve. So they have to stay ahead of it. And I do have them at 4.5% by year end. They can't afford to have that differential with the Fed funds target collapse anytime soon if they want to sort of stick to their inflation targeting mandate.
Okay, now earlier, Nikki, you already touched...
I mean, growth is fine.
Go ahead.
Yeah. Yeah, well, growth is fine. So it's okay to be hiking when the economy is growing. Just it's never a good idea to hike during a recession.